Welcome back to another episode of Accounting Focus. Here at Accounting Focus, we look more into soft practical standard questions to make the understanding more practical. Okay. So in our previous video, what we did was that we spoke about IAS 23 borrowing costs. And we mentioned to you that the IAS 23 focuses more on external debts. Is that not it? And what does it say? It's saying that if you should go and acquire any form of external debt, and you use this particular external debt to fund the construction of a qualifying asset. And what do we mean by a qualifying asset? An asset that takes a substantial period of time to get ready for each use or sale. If you use this money to fund it, there is a part of that borrowing cost that you have to capitalize, and the rest must be expense. And we also said that if you are funding, if you want to fund the construction of these qualifying assets, there are two ways. We have the specific borrowing, and we have existing pool of funds. Okay. Now, what we mentioned about this specific borrowing is that you purposely went for the loan so that you can use it in the construction of, let's say, a building. Is that not it? Or any qualifying asset. But when you say existing pool of funds, what it means is that you already have some debts already there, which you have not used. And then along the line, you had the intention to construct this building. What it means is that the building was there. It was acquired for a different purpose. But this construction came in and you decided to use it because it's already there. You already have the money. Is that not it? So this question is going to look at specific borrowing. The case where it is specific borrowing. And what do we say about specific borrowing? We are saying that if you go for that particular loan, right, from the start date of the construction of that asset, that is when you start to capitalize that borrowing cost as part of the cost of the asset. Okay. Any form of investment and income that arises, you must subtract it so that it reduces the borrowing cost. And what rate we use? We use the effective interest rate. So if you've not watched our video on IAS 23, check the link below so that you get an understanding, so that it becomes more practical. Okay, because I've actually taken my time to explain these principles. So without wasting my time, let's look at what today's episode is about. So when you talk about today's episode, you are going to solve a question on specific borrowing, okay? So that we see how it goes. On 1st January 2018, Target Company, on 1st January 2018, Target Company took out a loan of 1.6 million Ghana cedis at an annual interest rate of 20%. So they went to take a loan at an interest rate of what? 20%. Do you remember I told you that interest rate is always for the year? They won't give you interest rate for 5 years. No. They'll tell you that the interest rate is per year. From GBK Ghana Bank, GBK Bank to finance the construction of a housing estate for its directors. So you see, this is straightforward. They went for a loan, which was given to them at an interest rate of 20% every year. Is that not it? For the construction, to finance the construction of a housing estate. Now, if they are going to construct a housing estate, you know that housing estate will take a period of what? More than 1 year. It will take more than 2 years to even construct. Are you getting the picture? So this is specific borrowing. Good. There are to be 5 housing units of the same type, and the construction commenced on all the units simultaneously. Immediately, simultaneously. Okay, that is on 1st January 2018. So they started the construction of the building, all those 5 buildings. So they are constructing housing estate for their directors, right? 5 of them. And then they started constructing all of them at the same time. And when did they start construction? They started construction from 1st January 2018 until Unit 1 was completed and became available for occupation on 30th September 2018. Okay. Now, anytime you want to capitalize borrowing cost, we said that if you want to commence borrowing cost, 3 conditions must exist. Expenditure must occur, borrowing cost must occur. Activities necessary to get an asset ready for its intended use must also be in play. I hope you are getting it. And I also mentioned that when it comes to ceasing borrowing costs, when you want to end borrowing costs, when do you end it? You end it when the asset is ready for use. So the asset was ready for use on what? On 30th September 2018. We do not care when the asset was actually put into use. No, we are interested in when it was ready, when you completed the construction of that building. So they said Unit 1 was completed and became available for occupation on 30th September 2018. So that was when they finished completing that Unit 1 asset. So it means that if you are calculating the borrowing cost, we will look at it from what? From 1st January 2018 to 30th January 2018. And I'm sure that it's making sense. The house was actually occupied on 1st December 2018. So what I mentioned, that we did not care when it was occupied. The remaining 4 units remained uncompleted and were still under construction. So what it means is that if those units remained uncompleted and are still in construction, what it means is that for the whole year, from January to December, we don't know when they finish constructing. Is that not it? So from 1st January to 30th December 2018, all that borrowing cost that we incur, we have to capitalize it as part of the cost of the asset. Are you getting the picture? I get it. So let's take it. So A, what is the amount of interest to be capitalized for the year ended 31st December 20? So this is like a very interesting question. It's an interesting question. It's an interesting question. So solution. So we are looking at amount of interest to be so borrowing costs to be capitalized. So first of all, the housing were 5. Is that not? There were 5 of them. Now these 5 houses, we know that we've agreed that 1 was completed and then the remaining 4 were not completed. And we are using specific borrowing, which means that the interest rate must be what? An effective interest rate, 20%, which was given to us by the bank. Okay, so I'm first of all going to look at the completed. So let me change it. Completed. Okay. So what will be the computation for the completed? So first of all, what is the amount of the loan? How much is it? So the amount of the loan was 1,600,000, right? Times what? Times 20%. Are you getting the picture? Or before we even start it, let's look at, this 1.6 million were for 5 buildings. Is that not it? So if they were for 5 buildings, what it means is that they are going to share this 1.6 million among those 5 buildings. Is that not it? But only 1 was completed. So let me multiply it by 1 out of 5. Are you getting the picture? So that it will be times what? Times the 20%, which will give us the interest to capitalize, times when we start completing. When did we start building the asset? We started building in 1st January 2018. And when did we end it? We ended it in what? September. So how many months? That is 9 months. January, February, March, April, May, June, July, August, September. So that is 9 months. So it's going to be 9 out of what? 12. Are you getting the picture? So we are going to have Dana series here. So let's do our computation. So we are going to have 1.6 million times 1 over 5, right? Times 20% times 9 out of 12. So we are going to have 48,000 here. So 48,000 must be capitalized. 48,000 of the borrowing cost must be capitalized. Do you agree? Then when you take the uncompleted, let me use a different. When you take the uncompleted, okay, that's going to be what? 1.6 million times 4 out of 5. Why is it 4 out of 5? Because 4 out of the 5 buildings were not completed. Is that not it? Then multiply that by the effective interest rate of 20%. And they said it remained uncompleted and we're still under construction. So for the whole year, we assume that it was up to the end of the year, it was still in construction. So we'll capitalize it over the entire year. Is that not it? The months in there. So that will be 12 out of 12. Are you getting the picture? So we are going to have 1.6 million times what? 4 over 5 times 20% times 12 over 12. So what do we get? We are going to have 256,000. 256,000. Go. So if we add the 256,000 plus the 48,000, what are we going to get? We are going to get 304,000. So what it means is that this 304,000 is what must be added as part of the cost of the asset. Are you getting the picture? Are you getting the picture? So now we are going to look at, so this is A. Let's look at B. Now, the B is saying that what is the amount of interest to be expensed? Let me take the B here. What is the amount of interest to be expensed? Okay. So B, solution, B. So now, to know the interest to be expensed, this is how it's very simple. Let's look at the borrowing cost for the entire year. Okay. The borrowing cost for the entire year. Because we know how much out of this borrowing cost, some must be capitalized, some must be expensed. So let's look at the total borrowing cost for the year and subtract the amount that we will capitalize, the one that we are supposed to add up to the cost. We will subtract it from the total borrowing cost, and the remaining is what will be expensed. I hope it's making sense. So what it means is that we are going to calculate total borrowing cost. Okay. And that will be what? 1.6 million times what? 20%, right? Then times 12 over what? 12. Because this 1.6 million, we are calculating the total borrowing cost for all those 5 houses. Is that not it? So that's the entire this one. So we are going to have 1.6 million times 20% times 12 over what? Over 12. And what are we getting? We are getting 320,000. 320,000. Good. So now let's look at the amount to be capitalized. To be capitalized. So what is the amount to be capitalized? That's it. This is the 304,000. So we are going to subtract our 304,000 from it. Do you agree? It's making, because out of this total cost, some must be capitalized, some must be expensed. So we are going to subtract it, 304,000. This becomes what? 16,000. Are you getting the picture? So it means that this is the amount to be expensed. C. Outline the relevant information to be disclosed in the notes to the financial statements. So if you watch the previous video, I explained all these things. So disclosure. In terms of disclosure, what do? You have to tell us the capitalization rates that you used. Is that not it? And you also tell us how much of the borrowing cost was capitalized. So in terms of the disclosure notes, we are going to tell them that, okay, an amount of, so borrowing cost of 304,000 Ghana cedis would be capitalized. Okay. Then the capitalization rate used is what? 20%. Simple and straightforward. So if you appreciate this video, if you like this video, kindly hit the like button, share it to your friends so that they can also have access to this wonderful video. And if it is your first time joining me, kindly hit the subscribe button. So I'm going to release another video. Okay, I'm going to release another video where it will take the existence of what? Existing pool of funds. It will look at existing pool of funds. I hope you are getting me. And then I'm also going to take another video where it was combining both. At some point, you were having some money that you were using, specific borrowing. You went for, let's say you were having existing pool of funds, okay? You decided to start it, but at some point, you realized that no, it was not going well. So you decided to go for what? Specific borrowing. You see, we are going to look at what? The diversities. I hope you are getting me. So until then, we call it a day. See you, or